Hello and welcome to a brand new episode of Realty Returns powered by 99 Acres. I am Nandita Khemka. Well, today we are diving into a classic debate that every young earner wrestles with. Real estate versus stocks. Is buying property still the ultimate goal, or are equities the smarter path to wealth creation in a fast-paced world? And if you want to have the best of both worlds, how can you strike the right balance? Now, if you are in your late 20s or early 30s with some savings and wondering whether to go all in on SIPs or save up for that first down payment, well, you've tuned in to the right place. On the show today, we will be joined by Rohit Gera, Managing Director, Gera Developments, and Nirav Karkera of Fisdom Research. But first, here's a closer look at why spreading your investments across assets like equities, gold, real estate, and fixed income could be the key to wealth creation, especially in uncertain times. The tariff war has sparked a fresh wave of volatility across global markets, and investors have certainly felt the heat. Amid all the chaos, one lesson stands out loud and clear. Putting all your eggs in one basket is never a good idea. So, diversification isn't just wise, it's essential. That means spreading your investments across asset classes, from equities and gold to fixed income and real estate. Now, real estate and gold have always held a special place in the Indian investor's portfolio. Why? Because they offer more than just long-term appreciation. There's also the comfort of tangibility, and in the case of property, the added benefit of rental income. Young investors who've entered the market post-COVID have only witnessed a one-way rally in equities. Many have been caught off guard by the severity of the correction, since it's the first time they've experienced such a sharp market sell-off. And that's where the big lesson comes in, the importance of diversification. It's important to evaluate each asset class on its merit, understand the risk, the return, and the role it plays in your financial journey. Because when markets get choppy, a well-diversified portfolio is your best cushion. So investors, think beyond just returns. Understand your risk appetite, define your goals, and balance your portfolio smartly. Remember, real wealth is built not just in bull runs, but by staying balanced through the market cycles. Alright then, let's break down the myths, the math, and the mindset to help you find your investing sweet spot. Whether it's real estate, stocks, or a mix of both, let's understand what is the best approach for you. Joining me are Rohit Gera, Managing Director, Gera Developments, and Nirav Karkera, Head of Research at Fisdom. Gentlemen, lovely to have you right here on Money Control, Realty Return, our show. But Rohit, let's start this discussion with you then. Let's set the tone. What makes real estate and stock market investments fundamentally different? Some people swear by property due to emotional attachment, low volatility, touch and feel factor, while others are all in on stocks due to liquidity and diversification. Is it a mindset thing, Rohit?
No, I don't think it's a mindset related issue. I think fundamentally the asset classes are indeed different. That isn't to say one is better or one is worse. It's about which one you want to own at what point in time and in what quantum as a share of your overall investment, of your overall asset pool, right? So they're just different asset classes. Like you touched upon it, real estate is much less liquid, but real estate is the only asset class, or homes are the only asset class which you can buy based on today's price, get a mortgage and pay it over 20 years, right? You can't buy stocks with that. So with that kind of a model. So they're fundamentally different asset classes. And I think this is a great show to talk about when each person should be thinking about having real estate and to what extent within their portfolios.
Sure. Nirav, your thoughts. Do you think it's a mindset thing, given the fact that stocks are more liquid? First your thoughts, and then I'll come to the next question that I have for you.
It's always a pleasure to be chatting with you on such interesting topics. I would say that the distinction is far more nuanced, right? Like as an investment manager, I consider real estate very much as an asset class. And while the features may be distinct from that of equities, of course, there are other asset classes like gold, commodity, you have fixed income also that are distinct, right? So that doesn't take anything away from real estate. So there's a particular purpose that real estate serves, and there's a particular investment objective that can be achieved through real estate as well. So the way I look at life as just another asset class. So equity is one and real estate is another. Features may be distinct, but that doesn't take anything away from it as an asset class.
Let's say I'm in my late 20s or early 30s with some savings. Should I build my equity portfolio first or invest in a home? Because as I said, stocks are more accessible than real estate as they require lower initial capital. You can buy shares at any price depending on the market value of the company. But real estate depends on, in fact, demands a higher upfront investment. You need to make a down payment. So how does a young investor decide which path to take, and what are the deal breakers to consider?
So while the most obvious straightforward answer is only buy what you can afford, right? If you cannot afford a chunky piece of real estate outright, of course, you should lean towards the asset classes that you can afford. That is one. However, I'll use this as an opportunity to, clear the air around two important points, right? Number one is when we talk about real estate, we use it rather synonymously with residential home ownership. We must understand that real estate as a gamut is way
Hmm.
more beyond just homes, right? So it need not be just a home ownership that can construe as a real estate investment. That's point number one. And point number two, there's this wide-held belief that one requires a large corpus to invest into real estate, and there is it becomes very difficult for new savers, new earners to participate in real estate as much as they want to, right? So there needs to be a fine distinction between home ownership and real estate investment. If you have a lower chunk of money, also, this you can still invest in real estate, right? There are ways and means. You can invest in real estate through the
Hmm.
form of REITs. You can invest in real estate through form of mutual funds that invest in REITs a certain percentage. You can still
Hmm.
participate in real estate, right?
Hmm.
So I feel as a young earner, form a view on on the asset class you want to participate in, and identify ways and means in which you can do it most effectively, right? So start creating a more liquid portfolio through
Hmm.
stocks, but don't shy away from real estate and wait till you have a large corpus, or don't go in headfirst to take out a mortgage. You can always participate in real estate through
Right.
structured products like and mutual funds as well.
Very interesting point you made, from an investment perspective when it comes to real estate. But what is the kind of corpus one needs to have if they want to get started on their real estate journey, Nirav?
So, like I said, a lot of my conversation, I will be talking about real estate as an asset class, and not be using it interchangeably with home ownership.
Hmm.
Home ownership has a sentimental value. It serves a consumption purpose, and that must not be confused with an investment. So, if you want to start with real estate, you can invest with, as low as a couple of thousand rupees as well, by way of investing in REITs that give you exposure to underlying commercial real estate as well, right? So there are REITs, there are InvITs, which is an extension of real
Hmm.
estate. It is more on the infrastructure side also. So you can start with a couple of thousand also, and probably as you grow your corpus and you can buy an entire chunk of real estate on your own, that's when you start looking at it. So if you're trying to buy a chunky piece of real estate and
Hmm.
retain entire ownership of a certain property, you will need to gather a larger amount, probably a couple of crores before you start doing that, because you don't want to put your entire money into real estate as well.
Hmm.
And as far as the subject of taking a mortgage goes in, I feel look at it as an investment, right? If you were to invest in stocks, or in any other asset class, would you take a loan to invest into it? There are certain circumstances in which you would, right? And that's why we have margin trading facilities and all
Hmm.
of that happening. Right. So, but there are certain qualifying criteria. It is a particular stock for which you will be willing to do it. It is a certain conviction for which you're willing to take on the cost burden of a mortgage, of a loan in this case, right? So, view real estate also similarly. If you feel there's an opportunity
Yeah.
wherein the capital gains is going to far exceed the cost of capital, right? The cost that you're going to incur, by all means, go
Hmm.
for it. But have a very clear view that this is a very mathematical and scientific decision that needs to be made, and any sort of emotions that come into play takes away the
Hmm.
entire investment angle. Then it starts becoming consumption.
Rohit, coming to you then, a lot of pointers Nirav mentioned, and I want to, delve deeper into it. But let me come to you. How should a first-time, investor in the real estate space, decide that they're financially ready to invest? And secondly, beyond down payment, what are the costs that are often underestimated?
So, look, I think Nirav made a very valid point, and I completely agree with him on the aspect that buying your first house shouldn't be considered an investment. that's a need, that's shelter. Once you have that done, then we're talking about, I've got investable surpluses. Where should I put that in? Okay. Our real estate over the last few years with the introduction of REITs, as well as so many listed real estate developers today, you can actually make an equity investment in a real estate developer. And therefore, do you have equity exposure or do you have real estate exposure, right? I believe it's equity exposure because of the segment that you're in is real estate, and that equity exposure comes with its own sort of volatility and its own issues. Whereas I think what we're talking about is actually owning a piece directly of real estate or indirectly, and the indirect ways through a REIT. Now, the fundamental question which you've been asking is, how much money do you really need? And you can start an investment with a REIT with a very small amount. You can start an investment, a few thousand rupees, and you can get going with that, right? So I think given that we now have opportunities for people to consider real estate both as real estate within the equity space and therefore invest in listed real estate developers or in REITs. Or then the third category, which I think you're also referring to, is if you come out and say, I want to buy a piece of real estate for myself, not paper in a company that invests in real estate, but an actual physical piece of real estate myself. Now, that comes with its own set of issues. You need to have the right amount of capital for that. You should do that, I feel, when you've got enough of a portfolio elsewhere, and then you want to come into real estate. It shouldn't be your only asset, right? Because real estate is highly illiquid as an asset class. So investing in real estate is certainly good as part of an overall portfolio, but it shouldn't be your only asset. If you're thinking about buying the asset directly, and that's to your last question, apart from what you need to look at when you're considering buying real estate, you have to look at entry load, which is now stamp duty and GST, when you want to consider a return on that. So you have stamp duty, you have GST, which is an additional cost. If you own the real estate yourself, you have to consider property tax and common area maintenance over the duration of your ownership. So I think these are all aspects of ownership and costs of ownership that you need to consider when you're looking at buying real estate as an asset.
Sure. Very interesting. First, take exposure to these, listed real estate stocks, REITs, and then perhaps come into that physical property market. But, Rohit, the conventional thumb rule for equity allocation is 100 minus age. Is there any such golden rule for real estate? If yes, what is it like?
No, I don't think there is any such golden rule. I think it depends on the individual's needs. For example, if you get a REIT stock, or if you buy an office, a small office, or a small shop as an investment, it gives you rental income. If you're looking at saying that income is going to be what I'm going to live off the rest of my life, of that rental income, then that's a very different sort of approach. So I think real estate, there isn't any formula. It really depends on the individual, what your own needs are, what your own overall investable surplus available is, what the size of your portfolio is, and then you take a call accordingly.
Nirav, on that point, I want an extension here. Real estate offers rental yield plus appreciation, while equities offer dividends plus growth. How do you compare? And which one, according to you, is more stable?
See, it is a very good corollary to draw, right? Equity also gives up dividends, and real estate gives up rental yields. So I feel the decision should also be made very scientifically, like you would make with an equity, right? If you're entering equities for dividend, right, you want a certain sense of visibility on what's the dividend policy of the company, and for how long will the company be able to sustain profitability, and how long enough will it be able to pay out dividends. You need a very similar sort of a conviction in real estate as well. And in fact, if you are chasing dividend equivalent sort of rentals, then your investment must also take shape accordingly. For instance, there are certain REITs where there is distributable cash flow forming as a part of the total cash flow that adds up, and you can use that for your cash flow planning to some extent. apart from REITs, even if I were to talk about physical, real estate ownership, Rohit also, very briefly touched upon a very, very important aspect. And, while he spoke about shops and offices, it is largely under the gamut of commercial real estate, right? So if you are chasing, rental yields, it of course makes a whole lot of sense to look at commercial real estate over residential real estate, right? So this way you attune your investment
Hmm.
strategy along with this objective. So if you have a chunky piece of money, you invest in a commercial real estate where grade A office spaces in metropolitan areas fetch a rental yield of anywhere in the ballpark of 5 to 7%. Whereas residential yields in the same area would be
Hmm.
in the ballpark of 2 and 3/4 to 3 odd% of a yield. So clearly, if you're in for the rental yield, this is a very good opportunity that is available in terms of commercial real estate. And whenever you're buying such real estate, one very important aspect, I may be reiterating it, but I'll give a very easy to visualize example when talking about mortgages involved, right?
Hmm.
Think about it this way. Think about an inverse pyramid. At the top, you have the entire funding ecosystem, right? You have banks, you have AIFs, you have the entire ecosystem that
Hmm.
is willing to fund, right? You have private equities. In the middle layer, you have developers who take the fund and create form out of a barren piece of land, right? They make it tangible and physical real estate that can actually be leased, let out, bought,
Hmm.
and sold, right? And at the bottom of the pyramid, you have consumers who buy these developed projects. Now, at every level, there is a certain cost involved. So the funding ecosystem has a certain cost that the developers pay. Now, the developer has a certain cost along with their profit margins that the customer finally bears the brunt of. So the customer at the end of the day is not just footing the bill for the real estate land, but also the cost that comes at two additional layers. So while investing, even in commercial real estates, you must be very sure of do you want to pay to participate or do you want to get paid to participate? So if you move upwards in the pyramid and you participate by way of AIF, so for instance, 9 months this fiscal year, AIFs have pumped in around
Hmm.
the net 15% of its total exposure into real estate, around 75,000 odd crores, right? Swami Fund has alone injected around 35,000 odd crore funds. You participate through way of
Hmm.
AIF. And now this is assuming you can afford the ticket size. You move to the top of the pyramid wherein you get paid much better to participate in the real estate story, right? So there are different ways and means. It is a much more nuanced decision that you must take. But circling back very quickly to your primary question around rental yields, if rental yields is what you are seeking, and you feel more comfortable at the third layer of the pyramid, look at commercial real estate. And if you want to be much more
Hmm.
financially agile and create more diversity in your portfolio, move to the first layer of the pyramid, that is the
Hmm.
funding pyramid, by ways of participating in AIFs, REITs, etc.
Okay, that's very, very interesting and a good advice. Look at commercial realty. That's the word from Nirav. But Rohit, I was just reading a report by JLL, recent report. It said by 2030, 60% of new home buyers will be millennials and Gen Z in India. How has the perception of real estate actually changed from being an aspirational buy to now becoming part of a structured investment plan for young professionals? What would your advice be? I think the advice from Neera was pretty much clear. Do you concur with that?
Look, I think we are oscillating between that report which you referred to talks about these as being primary home buyers
Hmm.
as their own first home to live in, right? Whereas so
Hmm.
is that the sort of direction that we're talking about, or is it really from an investment point of view, right? This is the fact is we've heard for the last so many years, oh, millennials are not interested in buying homes; they want to rent versus buy, right? And I think that's an interesting piece to also talk about on the show, is that should you think of what are the advantages of renting versus buying? Because if you don't buy the asset, you have that money available to invest in some other asset class, right? So I think the general, we are back to the demand for housing across age groups continues to stay strong. Buying homes for self-use is continues to be a primary driver. There continues to be an emotional attachment to homes. So I think those are the drivers, and the need for shelter, right? And the need for security, which a home provides, are the drivers for buying a home for your own personal use as a primary home. Uh, when it comes to investment, and when what Nirav talked about, I just want to touch upon one short point on that. And he's absolutely right that if you're looking at pure rental yield, then commercial assets deliver you a 200 to 400 basis point benefit on the rental yield. But what we have seen and what I've seen over the years, a large number of people buy residential homes with the following hypothesis, right? You put in 20%, you already own your first home. You buy a second home as an investment, you can get a mortgage on that. Okay. You put in 10, 15, 20, you put in 15, 20% of your own equity in there. You pay down the EMIs for the first few years. The building is ready. You start earning rent, which may be 2.5%. But over time, the rents rise and you reach a crossover point when your rent starts paying off your EMI. Now, this could be 5 years, it could be 8 years down the line. So given that, that is a very attractive sort of proposition for a lot of people who've been buying residential homes where you may take your mortgage for 20 years, but in 8 years, the rent is now paying off the EMI, which means 20 years later, the property is yours free and clear, but you only paid for it for those 8 odd years. The other aspect to keep in mind in this, and again, this is a nuance, is that when you buy a home which is at the early stages of the project, right? By the time the project is ready 3 or 4 years later, there is already a rent bump on the first day of the first rent that you get as compared to what the rents are when you buy the home which is under construction. Now, you'll factor in your interest during construction and so on and so forth. But, and Nirav did say this, it is a calculated decision. It does require some amount of thought. And I'm glad this is coming up in this conversation because the general talk about real estate is, अरे यहाँ flat खरीद लिया, I've made an investment, यहाँ office खरीद लिया. But when you're thinking about buying a stock as at an individual stock level, the amount of homework that people do is so much more. And I think that they need to do that even when it comes to buying and picking the right property and picking the right asset class itself. So I do believe that there is a case to be made for rental yield on residential as well, but it really depends on what the individual's own objectives and goals are. And I think it all starts from there.
Very, very interesting point you made, Rohit. Also the point that people do a lot more homework when they are investing in stocks rather than property. But Nirav, since we're talking about stocks, is it a myth that stocks always outperform property in the short term? Over the long term, 15 years, Nifty 50 returns have beaten the RBI home price index returns, right, by almost 2%. Can that reverse given the interest in investing in real estate as well among young investors?
So, if we zoom out a little bit, right, and we force data together, you will notice a cyclical pattern between equity markets and real estate prices on an average. Of course, the housing price index is merely representative of the circle rates going, which I feel is very and much farther from the reality, right? And of course, Nifty 50 is also just a representation. But having said that, they both move in cycles and both participate very differently in economic cycles. Right, there's a certain cycle of the economy wherein there's a lot of money that also moves out from equity into real estate and vice versa. Right, so we have seen this cyclically over a longer period in time. However, having said that, there is very limited reason or proof or evidence that could very confidently determine which asset class is going to be the winner for the shorter term, that is the next 1 or 2 years, right? So will stocks outperform real estate? We don't know. In fact, it really depends on what kind of stocks are you holding and what kind of real estate you're holding. I feel the idea is a good investment will always outperform a bad investment. So a good set of stocks will outperform a bad real estate ownership and vice versa, right? So it is the quality of asset that will determine outperformance. However, looking at the way markets are, it is much easier to participate in the structural uptrend that we expect the stock markets to witness in the next couple of years, wherein you might have to exercise a whole lot more caution and selective approach while moving into real estate, because there are a lot more variables involved in real estate that may not be as transparent as those involved in equities, right? So from a sheer efficiency standpoint and reasonably higher degree of conviction, comfort around creating a higher degree of conviction standpoint, you could say that probably equity investors would at large outperform real estate investors. Now, I don't say investments, I say investors, because of the ability to participate and the ability to participate effectively and efficiently with a lower margin of error.
As we wrap up, Rohit, I want to come to you and ask you a very basic question. What's the biggest myth surrounding investment in real estate? According to you, what is that biggest myth that people really grapple with and that needs to be busted, so to say?
Look, I think what's important, I wouldn't call it a myth, but I think what people need to be very, very cognizant of are two things. One is the cost structure, which we already touched upon, but I think I would like to reiterate that. One is you have to calculate and you have to factor in your entry loads, which is stamp duty and GST cost. You have to keep that in mind. And there is a constant running cost as well. So I think those are keep the costs in mind. It isn't cheap. And the other thing is, from a liquidity point of view, you don't expect that when you need to sell it, you'll have a buyer overnight. So if you please do get into real estate, it's a great asset class to own, but keep in mind that there could be a time when finding a customer to buy that would be difficult, in which case, do you have other assets to lean on in a moment of crisis when you need the capital? It's very easy to sell in a booming, rising market. Certainly true for real estate as well. But when things are tough, it's harder to sell. So getting out of real estate isn't always very easy. And that's something that must be kept in mind when you're looking at making a real estate investment.
Sure, that means you need to have a little more patience when it comes to real estate. But Nirav,
yes,
which investment do you think needs more patience, stocks or real estate?
I feel any investment requires patience, right? Investments work best when you let it compound, be it any asset class, real estate, stocks, fixed income, commodities. I feel once you have conviction, the idea is to bet big and, stay patient, let compounding work, and compounding works across all asset classes. So I would put it at par. I feel both asset classes requires a lot of patience to really unlock the highest degree of value.
Sure. My last question to Nirav, really, if a young investor has 15 to 20 lakh rupees in savings, and if he has to allocate between stocks, real estate, real estate via REITs, perhaps, or physical property, how should one really go about it?
So first things first, I don't think he'll be able to buy physical property in any form or format with 15 to 20 lakh rupees, at least not in a reasonable market. So even if he puts his entire corpus, right, and the entire thing around making a down payment and EMIs, I said there's a mathematical calculation. Think about leverage and the cost of it, right? So having said that, I feel creating a more liquid portfolio, you're just starting off, dip your toes, get a flavor of how these asset classes work. Use a combination of equity, fixed income, real estate through REITs also, just so that you can get an understanding of how the asset classes behave. I believe if you're in your early stages of creating a portfolio, it could include stocks and real estate. The real money lies in learning how these asset classes behave over a period in time, especially if you're very nascent into the cycle. So do not jump the gun and try to make big bucks overnight. The idea is to learn the asset class behavior and slowly and gradually expand in the asset class you understand better and you can develop a stronger conviction on.
And Rohit, last question to you then. What is the kind of corpus that one needs to invest in physical property as well? Because of course, as Nirav has also mentioned, 15 to 20 lakhs, of course, you can't even think of buying a physical property. So, what is the kind of corpus one should have so that at least the down payment or a part down payment is, taken care of? And of course, one part of it could be financed through a loan as well, mortgage. So what is the kind of corpus, minimum corpus one should look at if he's planning to perhaps make an investment in a tier 2 city or tier 3 city for that matter?
So I think if you're looking at, you said a number of things in there. One is if you're looking at getting a mortgage, right? Then, and you're looking at a tier 2 or tier 3 city, you could have 10 lakhs in your pocket. You go out and get a loan for another maybe 50 lakhs. At 60 lakhs in a tier 3 city, you can get into owning a physical real estate asset, right? You move up to, let's say, Pune or a tier 1 city. You certainly need more than that, again, if you're looking at getting a mortgage. But in any of these cities, if you're not getting a mortgage, then tier 3, you need to start with at least 50 to 60 lakhs, I would think, because you want to buy something which is of a certain grade and a certain quality. You don't want to come in and buy anything and hope that it rises. So I think a tier 3 will require 50, 60 lakhs. A tier 1, and leaving Mumbai out of tier 1 in that sense, right? But I think a Pune, Bangalore, any of these markets, 80 lakhs, 90 lakhs, 1 crore, 1.2 crores, you can start getting into it if you don't need to take a loan or you don't want to take a loan. And Mumbai, of course, is a much higher entry point.
Point taken with that. Gentlemen, would like to thank you for taking out time and joining us on Realty Returns. Look forward to more discussions in the future as well. Thank you for joining. Now, hopefully our young viewers have a clearer idea of how to strike the right balance in your investment strategy when it comes to real estate and other asset classes like equities. Meantime, are you looking to invest in real estate? Scan the code flashing on your screen and explore top properties with 99 acres. Well, with that, it's a wrap on Realty Returns. Do send in your queries, feedback and suggestions in the comment section below. I'll see you next time. Thanks for watching.